All right, well, hey there, everyone. This is Kevin, and this is Friday, January 22nd, 2016. And this is my first options webinar for this new year. New website's out, and we're just so thrilled and so excited and so happy that you guys are enjoying the new format. Apologize, I had a little issue with the recording here, but you guys can still hear my voice okay, right? Just make sure there's no technical glitches and I end up talking for 20 minutes and nobody can hear me. Okay, super, great. Yeah, so these webinars that I will do are they're gonna follow pretty similar formats week in, week out. I'll have highlighted topics that I want to talk about, and I'll take, I don't know, maybe 10 or 15 minutes and go over something that I've been thinking about or something that I think is important, and I'll just share that with you, and we'll talk about trades, we'll look at the market in general, and really, guys, I'm just here for you. There's a handful of familiar names that I see in here that have been coming to the webinars from last year that I've been doing, and guys, I'm here for you. So any questions that you have, I just really want to take an extra minute and just emphasize, go slow and just try your hardest not to get overwhelmed. Options can be extraordinarily daunting in the beginning, and we've got a pretty wide spectrum of traders in this community that know absolutely nothing about options and have no desire, and that's okay, that's fine, that's wonderful. And then we've got traders that know a little bit of something, and we've got some very skilled, advanced level options traders in here. So my job really is to not overwhelm you and just share with you how I trade options and how I view the markets. Again, they're gonna the formats week in, week out are gonna be I'm here for you guys, so any questions you have, don't hesitate to type them in the chat box, and I assure you we will go ahead and get to them all. So that's pretty much all I really wanted to say in the beginning here. Today I'm going to talk mostly about finding your edge trading options and how we're going to use the probabilities. I sent out a couple of trade ideas already, and one was a big fat loser, and the other one is still going strong and should turn out to be a pretty decent winner. But the bottom line to all of this is I want to share with you guys what I have found to be the biggest stumbling blocks for those who are new to trade this style. That's not to say that you're going to stumble with the same things I stumbled with, but by sharing with you what I see to be the most common stumbling blocks for options traders, I hope that it helps shorten that learning curve for those of you that are interested in this. Options can be used to trade directionally, non-directionally. You can trade earnings, you can trade all kinds of scenarios. And what I want to do is just show you the simplest, most conservative way to take no directional opinion on the market and make money trading options. Now, you can also take some directional trades, and we have some amazing price action readers in this community that I have no doubt are going to be able to take some of this information and absolutely run with it. But my job, really, I view it as I just want to share my experiences with you, talk to you from a real world perspective. I'm not a professional educator. I'm a trader. I'm a nurse. I just enjoy doing this, and I have a passion for helping people. So let's go ahead and just get started. And guys, again, if we have any glitches, you can see my mouse moving, correct? I just want to make sure that there's no issues here. You can see a red circle, I hope, drawn on the screen. And then, yes, okay, super, all fine. So let's get rolling. Let me just check here one quick question. Bam says, as a test demo on the live trade idea in the SPY. I rolled the lower strike down a couple, collected $1.50 or so, and by the end of the day, because of the end of day rally, I was able to close at break even or better. What did I do by doing that? Okay, Bam, remind me and I will come back to that, and I will absolutely address that because there were some good questions that came up in the forums and also in the comment box on the on that idea. So what I'll do is I'll talk for first probably 15 or 20 minutes, just sharing with you guys what I'm thinking about. We'll do some questions, and then I'll follow pretty similar to what Mike did on his first webinar. I'll just take the last few minutes at the very end and show you and kind of share how I think is going to be the best way to get through my section and how you can use it with the tutorials, with some of the PDFs. I've already been getting some good email feedback from some errors in the trading manual. I mean, simple ones, not anything major, but yeah, edits that I will be putting together for the next version. So anything you guys find or want me to add in there, just send it off, and we'll make sure that it's as up to date as possible. So right off the bat, let me just go ahead and bring this over here. You should be able to see the screen. Options and probabilities. Okay, I like to view options as the simplest way possible, and really what I am most excited about is there's so many of us here that understand risk to reward and understand stops and take profit targets, and the whole math and the statistical side of trading. For the most part of it, traders are these left brain sided thinkers that are very logic based, very if then statement analysis. I mean, that's just the facts of the majority of options traders that I interact with are either they're either in the medical field, they are pilots, they are physicians, they're these kind of math and science based level thinkers that are very, very beneficial to have those traits. However, you also need to have that ability to view this as options trading is going to be part science and math and part art form, right? I mean, we're going to have to develop the edge by practice, by consistency, by trading on demo until you have that confidence knowing what it is that you're trading, so that you don't open up your first live trade and get your face ripped off and lose half of your account, right? So I like to start, I think it's important to start this very first webinar out talking just about the probabilities and the math and the edge and why I think that's so important. And please just again send out some questions as it maybe triggers some thought. My main goal is to just keep this very, very simple. I put this slide in every single presentation I do, and I think it's important because really options are very complex, can be very complicated. There's a lot of new terminology, there's definitions, there's vocabulary, and let's be honest, it's going to take a little bit more work on your part to kind of get through that and to understand, when we start talking about strike prices and expirations and risk profile graphs. I mean, a lot of new things that for some of you, it may be the first time you've ever heard some of these terms. And I don't want to make it so complicated that you just throw your hands up and you're like, yeah, well, screw it. That's not worth my time. It is absolutely going to be worth your time. And I fully believe that those of you who are willing to put in the time with this, 6 months, 12 months, it's going to take some of you maybe 5 years. I don't know. But the effort that you put into this will absolutely pay yourself, pay you back. But we got to keep things very simple so that it's easy to follow the thought process. So right off the bat, I'm going to just kind of piggyback a little bit off of several posts that have been in Jim's threads, what he's been talking a lot about, because this is what everything hinges on, guys. This is so pivotal to accept, and especially for currency and futures traders. You have access to a 24-hour-a-day casino if you want, and to be able to understand that if we're going to be a trader, if we're going to call ourselves traders, well, then yes, we're buying and selling, but we also need to understand that there is a huge emotional component to anytime you talk to anybody about money and how that impacts you, whether that's a little bit, whether that's a lot. And if we're coming at this already with that confused mindset of, I don't really know if I'm a gambler, if I'm a trader, it's going to just make things so much more difficult. So if we focus more on this as you're a trader, this is a business, you're disciplined, you're structured, you're going to put maximum effort into this, and we can accept that, some people just can't make that, they can't bridge that gap. Well, that's a great place to start, because then when you accept, all right, you know what, I am a trader. I'm a trader. I'm going to view this as a business. I'm going to carve out certain hours of a week to devote myself to study. I mean, it's no different than a university level course, right? Where you're expected to be there so many hours a day or a week, or you get graded on exams and quizzes and things like that. So if we can keep things in that structured, disciplined approach in as simple of a format as possible, well, guess what? Then we can determine, you know what, man, I have a lot of gambling tendencies, and so I have to be aware of that, so that when I find myself putting on too big of a position or too big of a trade for my account size, well, then I can ratchet that back a little bit quicker, so that the market turns against me. I don't give up 3 months of gains, being a successful trader, and one moment of weakness because I didn't sleep well enough, or I didn't exercise that day, or I didn't whatever the variable is that takes you out of your trader's mindset. I probably think more often than not, I know for me personally, I will tend to sometimes default back to that little bit of gambler's mentality, right? I mean, I'm just being honest, guys. That's the reality of it. So, we really got to address that first off, right off the bat. And so we can all learn the mechanics and the vocabulary and the terminology of what it takes to be an options trader. But if we're still gambling away and not really thinking about how important this is, doesn't matter if it's options or futures or currencies. I mean, we really got to get that under control. So being a nurse, I'm a medical guy, and I just want to talk just for a second. I promise you this is not going to get stupid crazy or anything, but this is why the emotions that we bring to the table when we trade are so relevant to have just a quick couple-minute conversation about, all right? Because this limbic system that we have in our body, in our skulls, the amygdala that sits, it's a little almond-shaped organ that sits underneath the, skull, that really kind of controls a lot more than you realize and recognize. So, we have to understand, and we have to at least be aware of that. And if that is what drives a lot of our kind of our fight or flight mentality, right? I mean, we've got that epinephrine and norepinephrine that's released in our body. If we're in a moment, if we're walking down our street and all of a sudden a 500-pound lion is chasing after us, what's going to happen? Instantaneously, your heart rate's going to elevate, your pupils are going to dilate, all your blood is going to constrict to your core organs, and you're going to run to get away from it. That is an emotional response. You cannot physically control that. And so that's that's developed and that originates from this limbic system in your body, in your head, in your skull, and it's, I mean, that's a fact. That's anatomy. That's pathophysiology. And so during, say, a trade that's gone bad, you've just quick willy-nilly thrown a trade on because you read about it, or you thought about it, or you wanted to, you know, you haven't had a trade for a couple weeks, and so it's time to get something on, and you didn't really think through the plan, or you didn't really plan anything, you really didn't have any idea what you're going to do management-wise, and it starts going bad against you. It is causing, and it will cause, an emotional response in your body. I mean, we can all agree on that, I think, if we've been trading longer than a couple of weeks. We've all experienced it, we've all felt it, and that's when this uncertainty and this fear comes into the picture, and we have to understand where that comes from, because if we can recognize that, and we can accept it, then guess what? Then the next step is, all right, well, now what do we do about that? And so by approaching it from, let's understand what this thing does, so that when we understand it, and it focuses mostly on the negative aspects in our current environment, whether that's a lion chasing down the street, whether that's a trade going bad, or whether that's you smell smoke in your upstairs bedroom, that negativity bias that comes from that fight or flight response that's generated from your amygdala, all right, can absolutely be controlled. And I'll tell you, the way you control that is by recognizing that it's primarily a negative biased organ, meaning it's going to respond in a nanosecond when something negative is occurring to you, and it floods your body with hormones that change your emotions, right? I mean, it changes your thought process from being very structured and very logical and very rational to irrational, and just, you know, maybe it turns you into a crazy lunatic. I don't know. But the ability for it to cause and elicit a response from something negative is what keeps you alive, and what kept us alive hundreds and thousands of years ago, right? And we've just developed to a much more civilized society, but that little almond-shaped organ's still in our body, and it's still operating exactly the same way as it did so long ago. So if you have something positive that occurs to you, well, it takes a lot longer for you to recognize that and be aware of it, because you don't have that intrinsic mechanism that's turning you into a fight or flight, get out of the situation, or fight to save your life type scenario. So I'm not gonna continue just blabbering about that, but I think what I want you to take away from this one little piece of information about your limbic system is we all have it. It's very powerful, and the way that you can keep it in check is by not gambling, is by keeping your trade plans predetermined, or pre-written when you're getting ready to enter a trade. Why I am a huge advocate of taking screenshots, keeping a trade journal, buy Camtasia and document your trades in audio, video fashion, whatever it takes for you to make that trade plan successful and work for you. Well, do it, because the negativity that comes from your body in an emotional situation is so much quicker and so much more powerful than anything positive that you can find yourself in. Perfect example. The biggest emotion that traders struggle with is not getting out of a trade too early, or not getting out of a trade too late, or holding your stop too long. Do you want to know what the biggest, absolutely fundamental biggest thing that traders get emotional about is? That fear of missing out. all right? Everybody else is participating. Everybody else is getting a piece of this, and I missed it. Damn it, I'm an idiot. I'm a fool. How come I didn't see it? I mean, you guys see where that goes and how quickly that gets there. And so we start getting big moves in the market like have been happening recently. How many times, I mean, let's be honest here. I'll throw my hand up. How many times you've thought, man, why didn't I just do this? Or why didn't I just buy a couple extra puts? Or why didn't I do this? Or, look at all of that. You can't do that, because if you do that, that already, I mean, and we all do it. It's going to happen, and it's going to change that emotional element to your trading. So I think that's important to spend just a couple of minutes just talking about, because it's very relevant and it's very powerful. And at least if you're aware that it's there and the implications it can have to your trading, well, then maybe it helps drive home the point of the conversation of why you got to have a trade plan and why you got to know what you're going to do long before you're ever going to do it, so that you're not operating on these emotions. All right, so let's just keep going on. Sorry, I got a little carried away there. So options, they're super simple. It's math, right? It's understanding buying and selling. It's executing trades. I just put this on here because I think that too many times we think that more is better, and actually it's quite the opposite. More is just more, and it's more distraction. It might be more, I don't know. Distractions are probably the best word that I can think of, because when you have all of that going on, you're going to let other people's opinions maybe bias what it is that you want to do. And so when you can turn all that off, it lets you control what you have control over. And the only thing you have control over is you, right? I mean, it's not nobody knows what the market's going to do. We make educated guesses, and we think it might be this and it might do that. And I can watch these patterns and I can identify these zones of interest, but ultimately, really, nobody can predict anything. And if you just control what you can control, which is your emotions, your mindset, your thought process, well, then you've all of a sudden stepped into the world of, all right, well, now let's just control the simple math calculations and the statistics and the probabilities that are proven to work time and time again, and not worry about what the market's going to do. So I think that when we talk about that, options are just they're just very simple. So if we look at why I'm talking so much about probabilities, it's because, I mean, we've all been into a casino. If we have gambling tendencies, we know why the casinos are the way they are, and it's all about the edge, right? It's finding that house edge, and if the house is always going to win, it's because they have that edge, right? And even if it's the smallest of small edge, the edge will always win. It's always going to overpower. Now, you might have some outliers, and you'll definitely have, fat tail events, but I want to use the illustration of, flipping a coin, right? I mean, so how can you find your edge in flipping a coin? Well, it's because if I flip a coin, it's either going to be heads or tails, so it's 50-50. There's no edge either way. But if I am flipping that coin 10 times, I might have 5 heads, 5 tails. I might have 7 heads, 3 tails. There's a chance I could have 9 heads and 1 tail, right? But if I flip that same coin 1,000,000 times, or 10 million times, or 2,000 times, that bigger data set, that bigger sample size is going to give me much smaller variations. So I don't want to say it's impossible, but I think that if I had a 10,000 flip sample size, it'd probably be highly unlikely I would have 9,000 heads and 1,000 tails, right? I mean, maybe. I don't know, somebody can probably figure out what the odds of that are. But you know, if I had a 10 flip sample size, well, yeah, I could possibly have 9 and 1. So I want you to be thinking about that, because it really emphasizes why I talk so much about keeping your trade size small. You know, if the margin that we're putting at risk is only going to be 5% of your entire account value, if you're trading a $10,000 account and you only want to put 5% of margin ever at risk on any one trade, well, you know, that's only going to be putting a $500 trade on. And so the very next question I get is, well, if I'm only going to be risking $500 a margin, and say that I only want to take a max loss of 10 or 15% of that $500, I'm never going to grow an account, because I am only going to be making $20 or $30 or $50 a trade. Okay, but you're going to be preserving your capital, and you're going to be building this data set, or this sample size, right? So at the end of 6 months, or at the end of a year, or at the end of 2 years, if you're trading multiple strategies and multiple methods, and you're trading a couple times a week or a couple times a month, and you develop and you build that confidence, okay, that $10,000 account is probably not going to be at $10,000 forever. And when it becomes $100,000 or $200,000, all right, now all of a sudden you have confidence in your methodology, because you've taken that same trade, you've taken the same skill set in similar market conditions, and you've got a larger sample size, so that you know what are the odds of one thing happening over another. Okay, so I think that's the biggest thing that we have to address, and we have to talk about, is if we can find a methodology that gives you a positive edge. All right, and what I mean specifically by that is, if I have an edge in a trade where I know through history, or through back testing, or through live testing, that a particular strategy is going to work 8 times out of 10 consistently with a large sample size, you know, 500 or 5,000 trades, individual trades across many different market conditions, and I have a edge that gives me 7 winners for every 3 losers. Okay, well, now the easy, very simple next step is, now we just construct our margins so that strike rate that is very, very positive has trades that, if we have a risk 1 to make 1, all right, great. We can even risk 1.5 to make 1. And it just gives you a little bit different perspective to maybe look at why options can be so intimidating sometimes, because you have a lot more different variations on how you can trade different strategies. All right, but to kind of come back to the beginning of this trade, or this slide, we're just talking about probabilities. We're talking about finding our edge, and the larger the sample size, the better our odds are going to be in our favor to understand how these trades work. Okay, and I'm telling you, I have several different strategies and methodologies of trading options that are high probability options trades that have absolutely terrible risk to reward parameters, but win 80 or 90% plus of the time. All right, so edge, right? We just want to define it real quick. We know that it's in a given set of working conditions, one high probability of one scenario work more than the other, and we just want that edge to be in our favor, whether that's having a better risk to reward, whether that is having higher strike rate. You know, if our edge is at least greater than 50%, right? If the edge is in our favor, then we're going to make it. And then it's just how we follow through on our plan. So it's got to be realistic. It needs to be appropriate to your particular time frame. If some of us are only trading on the daily charts, or we can only execute one trade a month, that's what we have to recognize, and that's what we have to trade with. It's also got to be fit for your own unique personality. We've got what, 30 some of us in this room right here, and we're all going to have different personalities. And just because what's going to work for me does not necessarily mean it's going to work for you, but it's going to be something that you find your edge, and if you can fit it to your own personality, then it comes back to, guess what? I just have to practice it. I have to be patient with it, right? Let's understand this is probably going to take twice as long as you want, and you're probably going to make about half as much profit as you want while you're learning this. And I mean, I'm not trying to paint you guys any kind of hyped up picture. It's going to take work. It's going to take determination. But you know, the power and the ability to create ridiculous amounts of wealth with options is what gets me, I mean, really geeked up about sharing what I know to be true in the markets. All right, so lots of practice, lots of patience. You have got to be persistent with this. And lastly, you know, the 4 P's I put down there. You gotta be, you know, perseverant. You have to stay the course. It's going to get easier. It's going to get harder. It's going to get easier. It's going to get harder. You're going to learn. You're going to forget. You're going to, you know, you're going to have these many aha light bulb moments that are going to go off many, many times. So, you know, finding that consistent edge and that positive edge will help you keep those emotions in control and in check, so that, you know, you're not gambling, you're actually trading. All right. So underlying asset, this is again why I think it's so important. I want you guys that are new to this, we want to stay in the most liquid, high volume, tightest spread assets as possible. Just because I say, well, let's stay in the SPY, or let's stay in, you know, IWM, or let's stay in the big volume assets, doesn't mean you can't trade in other things. Anything that has options on it, you can trade it, but just be aware that all of these elements are going to add extra variables and extra challenges while you're trading them. And especially when you're learning, don't make it more difficult in the beginning. It's already going to be extra challenging enough. Don't make it more so. And so if you're going to trade something like, I don't know, IBM or Apple, for example, those are big blue chip companies. They have a lot of options. They have a lot of volume. Spread's pretty tight. But look at that. You've got earnings to worry about. And too many times, more than I care to share, you know, I've gotten killed on an earnings move because either I wasn't aware of the earnings, or I underestimated the move, or it was a surprise move. So take that out of the equation while you're learning. Don't even trade them things. Don't even trade anything that has earnings attached to it, or anything that can get psychotic on you and you know, all of a sudden you wake up one morning and it's lost 50% of its value, or they've just found the cancer drug, and now all of a sudden the company that got that contract is, you know, 100 times. It's not even worth the risk. So just stay away from it until you feel comfortable accepting that risk, right? And so I think these are kind of important things to understand, and why I hammer that so much in the beginning. In the boot camp lessons, you know, I spent a couple of whole complete videos talking about this, why it's important. And you know, for those in the beginning, for you guys learning and just starting out with it, let's just make it as simple and as structured as we can. So the really, really highly liquid, high volume assets is where I'd love you to just stay at. And so that's kind of why. All right, so risk reward discussion. Why do I want to talk about that for a second? Well, because these are the various different ways that you can trade options. Let's just say that trader A You have two traders, and trader A, he has only a 20% winning strike rate, and his wins are 5R plus every single time, but he has to take a lot of 1R losers over and over and over and over again. For me, that I can't do that. That absolutely drives me bonkers. I cannot handle that kind of drawdown, and so I accept that and I understand that. And so for me, I may be more like trader B, where I can accept a lower R profit because I have proven to myself that I can find trades that win 70, 80, 90% of the time, right? So if you understand that in the beginning, then it makes that risk to reward discussion that is inevitably going to keep happening about, well, yeah, but you're putting $500 in margin at risk and you're only going to be making, $50. Okay, yeah, maybe. But making that $50, knowing that I could close it for a $50 loss at any point in time that I wanted to, and it gives me a 70% strike rate, all right? So the absolute risk to the potential reward is a little bit different than taking your 50 pip stop, targeting 200 or 300 pip of a profit target. And so, you just have to be honest with yourself. You have to ask yourself in the beginning which kind of a trader you're going to gravitate towards, and you will see over time through these webinars. I'm going to share many different types of risk to reward scenarios where we're going to risk 1 to try and make 20. We're going to risk 20 to try and make 1, and there's going to be a variety of everything, so that if you are that trader A that you can handle losing 4 trades for every 1 winner, all right, well, you know what, we probably have something that's going to fit your bill that you're going to absolutely latch onto and run with. But you're not going to know if you don't get exposed to all the different types of trades and methods. All right, so we'll just go back to that real quick. We're trading on probabilities, not profits. I want you guys just small position size over and over. I'd rather have you do 50 small sizes and 50 small trade sizes instead of 5 big ones. Even though the odds are just as good that you'll win on those 5 big ones, just keep the things small when you're first starting out. All right. Find what works for you, what doesn't, for your own personality, and please don't ever put Don't jeopardize 6 months worth of profits in one trade. And I say all the time, I would rather lose money knowing I followed my plan and I traded according to what I was going to say I was going to do, than to get squiggly wiggly and then all of a sudden I'm making these wins and I can't reproduce them. I didn't follow my plan. I got caught up in the emotion. I got it's not a way to find that consistency. And that's what I want to teach you guys. I want to show you guys consistency. I want to share with you what I know works and what you can reproduce over and over and over again. And trades are going to lose. And we'll talk about the first live trade idea that I sent out. It was a loser. And guess what? If I wouldn't have closed it, it'd be a winner right now. I'm okay with that, because I know that I followed my plan, and had I broken my plan and said, well, I said I was going to do this if it got under 185, and it got under 185, and it could have just as easily continued on down. All right, well, you know what that does? That reinforces negative behaviors, because you can't out trick your mind. It knows absolutely. You said you were going to do one thing and you lied to yourself and you didn't do what you said you were going to do, and it reinforces that negativity bias. And so it's a slippery slope. It's a dangerous game to play, and that pulls you back towards that realm of, man, maybe you actually are just a little bit more of a gambler. Maybe you're not really a trader so much as you think you are. And so I want you guys to be aware of that and be thinking about that, because you cannot get biased if you have 5 or 6 losers in a row. I forget the member that's in the forums right now, but somebody's on a kind of a really down streak right now, and they've had a lot of losers in the last several months, and they're kind of getting down on themselves, but they're following their plan, but they're just they're not finding the trades. That's going to possibly happen. And when it does, you just have to persevere. You have to persist and keep pushing on, because you'll have the breakthroughs. And then the reinforcement of knowing, man, that sucked. That was hard to get through, but I followed my plan. I did what I said I was going to do. When you come out on the other side, you're going to be a night and day different trader. I promise you, I assure you of that. Okay? So there's, strategy. It's seriously, it's not about the holy grail. There's only one strategy that's going to work. It's going to be, I've found that this butterfly, man, it's in vogue right now, and everybody's doing it, and it's working, and it's, boy, mortgage the house and put it all on that. No. It's one of many different strategies that will work. And it's about you, and it's about how you can manage the strategy, and how you can keep your ego and yourself in check, so that while you're learning these different strategies, you'll find one that kind of just talks to you a little bit better or a little bit easier than another, and then you can lean into that one and build the money management skills and the risk management skills and the strategy specific skills. What starts out as maybe 5 or 6 or maybe an upwards of 10 various different strategies, you will find that as more time elapses, you'll gravitate towards 2 or 3. And you might ultimately only find one that you trade over and over and over and over again, but you're not gonna be able to figure out which is that 1 or 2 or 3 types of strategies that you deploy until you trade all of them, right? And we trade all of them on demo and in paper and small, so that you can see how they all perform. I hope that makes sense. But this is why options traders, this is why traders in general are going to fail, because you're not following your plan. You're thinking that, well, if medium level complexity is good, then if it becomes way too complex, then I'm the only one that can understand it, then it's got to be the best one. It's simple is better. Simple is better. Always keep it simple. If you can't explain to somebody, go out in your street, in your driveway, and grab your next door neighbor who is maybe nothing to do with any kind of trading, and explain to them in under 10 seconds why you're about to put several hundred or several thousands of dollars on the line. And if you can't do it in a really short, condensed 10-second conversation, maybe you should rethink that. All right, maybe you should understand why it is you're willing to risk money in a market that anything can happen at any point in time, right? Why, if it's got to be so complex that you need 3 degrees to understand it, it's too difficult, it's too complicated, and you're not going to find that consistency to be able to replicate it. And then again, of course, obviously just trading too large. So that's, man, holy cow, I've been talking for 45 minutes, guys. I'm sorry. I seriously hope, I see some of you guys still here, so that's good. I've got no questions yet, so maybe nobody knows what to say, but just go slow. Take your time, be patient, understand this is going to be a process, but if we can be aware of the emotions, and we can keep this as precise and as structured and as simple as possible, that's going to put the edge in your favor greater than 95% of the traders that are out there. Because, I mean, really, let's be very candid and very honest. The majority of traders are gamblers. If you're going to be honest with yourself, a lot of biases is towards that quick buck and the flashy lights and the click the buttons and the draw the trend lines and it's really, if you're aware of that, then we find our edge and we pull ourselves out of that gambler's mentality and we begin to be traders. And so we'll just close on that. That's been my little tagline ever since I've been in this community. I think it's super, super important. You can anchor and hang on to something. It's going to be different for all of us, but I like these quotes, these inspirational and motivational quotes that Bruce Lee or Henry Ford, Marcus Aurelius, all these guys that you see all over the time, all over the place. Because then when you get discouraged or you get down a little bit on yourself and you're by yourself and you're in your apartment or you're in your house or you're with a couple of friends and you're trying to struggle through all of this, well, you can kind of lean on to something that maybe helps keep you centered and keeps you coming back to why you're trying to do all this anyway in the first place. So I like that. I mean, that speaks to me. That's helped me at many different times when I've had defining moments if I'm going to keep trading or just close it up and just not do it anymore. So find something that works for you, all right? And then we will just close it on that. Questions? Right. Let me just minimize that down. I have talked for 50 minutes, 46 minutes and 30 seconds. Please, somebody ask me a question, or just tell me you can still hear my voice, because I wanted to spend all of my webinars are not going to be like this, I promise you, but I think that in the very beginning it has to be about the psychology, it has to be about the emotions, it has to be about what are your expectations, what do you want to get out of this, and for me, I think that's where the opening conversation has to begin. Is what do you want to get out of this? Why are you willing to invest your time and energy and effort to learn something that is going to be a little bit more difficult than just straight up buying or selling currencies or futures or commodities or equities? Why are you willing to spend your time to learn this? And so let's see what that does here for the chat box. I see a few of you guys typing, so we'll see what that brings up. And then if that has no questions, I will. All right, good. So we got a few questions going. All right, so. All right. Swami says, great so far. Thanks. You're welcome. Tucker says, great stuff so far. Really important. Yes, I agree. Forex says, what to look for in VIX, Greeks, with respect to price action based directional trading. Any pointers about what to look out for? In the money, near the money, out of the money, etc. Yeah, so Forex Doug, yeah, sure. Let me, I'll bring this over here, because I'm sure that you guys have seen this in some of my webinars. This is this is what I look at when I'm looking at the computer throughout the day. All right, so what I am thinking about and what I am looking at when I'm watching the market and I'm trying to execute a trade, or when I'm trying to manage a trade, really, we're looking at areas of extreme. All right, let me back up. Sorry. If you are a directional trader, you're obviously going to be looking at pivot point zones or edges of the boxing or areas to where you expect some kind of a reaction. And then if you see a reaction, so we'll just look at this one right here. This is the Russell on a weekly chart, right? I mean, look at that, guys. That's a ginormous pin bar on the weekly time frame that has violated prior swing point low. You can see the flip right here at the 1,000 level. I mean, you can see the flip back here in 2013 where resistance became support. It tested that. Prior to that, you have an obvious flipping point here, and we came down here, we tested it, and now we're fixing to close the week inside of that area. So if this is an area of interest and I want to take a directional trade, all right, well, I'm not going to take a directional short, right? I mean, we can all agree on that. If I'm going to take a directional, it's going to be a long trade. So I may either say, well, I'm going to get in now. I'm going to wait for a break of the high. I may wait for a retrace to the middle of the wick. I mean, there's all kinds of ways to play it. But if you're a directional trader, it's going to be no different utilizing options than if you're just going long or short the underlying vehicle. What options are going to add to your plate are going to be a little bit more leverage, a way to better define your risk, meaning if you're trading a futures, if you're trading this on the TF, and we look at that, well, if you don't have enough capital to trade a TF or an ES or whatever the contract is, you can use options to get a little bit more granular and put on different position sizes so that if it goes in your favor, well, you can scale out, you can begin to reduce your risk in that dynamic fashion like Mike is so skilled at teaching about. You can reduce that risk while still hanging on to a trade targeting bigger moves. So if you're a non-directional trader, then of course obviously we want to be looking at trades where we have kind of that ranging area. I mean, this was a great market to trade sideways ranging because we had pretty big up days, we had pretty big down days. We had weeks to where we had 2 weeks down and we had 1 week that pretty much erased all the move. And this is what I'm referring to right here. Let me just, these 2 weeks right here, you had one bullish week that pretty much erased all of that activity. So as a non-directional range-bound trader, that's ideal. That's optimum because you're not selling or you're not buying areas of extreme. So, from your directional to non-directional trading, those are kind of some things that I'm on the lookout for. And if I'm going to take a directional trade, the deeper in the money I go, the more expensive these options are going to become, but the less sensitive they are going to be to changes in volatility. And so volatility is your VIX level or your RVX right here in the Russell, and all your volatility level is telling you is what is the uncertainty, where's the fear coming out at in the market. And if you can see right here, we will just zoom in here. This was the end of August when we had the gigantic move down. I mean, we can look at Russell and we can say this was August, right? I mean, this right here, we can pretty much let's look at August 18th. We had a bearish day. We had a gap open down. We had another gap open down. We had another gap open down. We had 5 days in which the Russell went from 1225 to 1110. That's a big move in a short window of time, 5 days. All right. So starting at August 18th, if I say RVX and I go to August 18th, well, look what RVX was doing then. It was well defined within a range of 16 to 23 and a gap open and down. Well, it was a gap open and up and another and another and another. And every subsequent increase in volatility makes your option prices and your option premium accelerate that much more. So you net sellers of options way up here, you want the volatility level to come back down. You net buyers of options down here want the volatility to explode up. And the deeper in the money you go using options, the less sensitive you will be, the less sensitivity you will experience towards changes in this volatility. It's going to be more price movement. All right, so you leverage the ability to use options, but you don't get the volatility impact when you go in the money. So the reverse or the converse is true. Out of the money, it's a lot of sensitivity to changes in volatility. And so, you learn that by just if you have a directional bias, you think this market is toast and it's going down, well, get on your demo money platform and buy some puts that are out of the money and buy the same thing in the money and do comparisons. Which one moved more? Which one changed less? I mean, and that's how you build these data points, by just practicing and watching how they respond. So let me know if that helps. Okay, if that answered the question or not, because that will get more and more clear as more time passes. So Eladine says, great, thanks. So are you planning to take us in a structured manner from month 1 to month 12? Yes, I am, and some of that is going to be on your shoulders as well. So let me do this. I'll just bring this over here. So this is the tutorial section that I've got up on the main site. So I'll keep answering questions, but let me just go ahead and spend the next few minutes talking about this over here, because the option foundations, this will continue to build as time goes on. As I've already gotten several edits to the trading manual right here that I will be uploading here in the next few weeks. This is going to continue to evolve, but these foundations will really give you a clear idea on the terminology that you're going to hear me using, some checklist steps to really be on the lookout for and to watch. If you're directional, non-directional, just different things talking about options. As far as the Thinkorswim platform, that's going to be the next section. That's what I trade on. I do all of my trade modeling and testing on OptionView, but I do actual trade execution in Thinkorswim. We've got Trading Mindset Bootcamp. All right, so 12 months. To answer your question, Eladine, yes, I will be taking you with these webinars. I've got so many topics I want to talk about. I want to talk about how to trade a bear strategy, how to trade range bound, how to set goals, how to be realistic in your expectations, unwinding trades, what's your targets, portfolio margin. Many, many different things that we'll be talking about through the coming weeks and months and years. But this 12-month process, I think, will help you get started to, all right, for the first couple of months, it's really not going to be beneficial or advantageous for you to be trying to watch or replicate or duplicate complex hybrid trades when you're still trying to learn and navigate and figure out the platform, or what the heck is a in the money call option mean. So I think for the first several months it's going to be really about understanding the platform and trade execution and calls and puts and directional type trades, so that you can become familiar with options. And if they are completely foreign to you, that will help you so much more so than trying to jump all the way down here. And we're going to be talking about butterflies and why the unbalanced wing butterfly is so much better than balanced with hedges. And all these advanced or maybe intermediate level topics. But as you practice and you go through these various different months, you will begin to see the common theme that will be very relevant when you either watch the webinars live or you watch them on recording. And guys, I'm even willing, you guys that are really truly hardcore into this and want to learn it, just send me emails, send me comments. I will always reply to every single email, and I will reply to anybody that starts an options journal, because I think it's so important that you have that constant contact so that you don't feel like, oh man, what does that mean? Or I don't understand this. No, I'm here for you guys. And you're going to get as much out of this as you're willing to put into it. So yes, I am going to take you in a very structured manner from point A to point B. But certainly make sure you use this tool here and follow the sequence of the videos that I put down there, put together. So, all right, Wilhelm says, I struggle with coming up with a trading plan. What would you suggest to structure a plan? So to structure a plan, you know, really, my trade plans are really simple in that I take screenshots before I enter the trade. I take screenshots at every trade adjustment. I take a screenshot at the end of every single day. I make notes to myself. And so your trade plan in the beginning when you're starting out can be as simple as, okay, you know what? Let's go back here. I'm looking at this market. So here's my trade plan. Here's a Russell weekly chart. I think a pin bar is going to find some support here, and I am going to target 1100. My stop is at 1000, my target's 1100. I am going to go in, and my trade plan is to buy some long calls and watch and observe if the market moves in my direction, how quickly they become profitable, what is the effective theta. If it moves against me, how quickly do I lose money, and how small the theta becomes as it moves against me, and what I will do if I reach 1100, say in 3 weeks. All right, so your trade plan can be something so simple, but it needs to be stated, it needs to be documented, it needs to be put down in writing, yes, but boy, the visual images just, I think, are even as powerful, if maybe even just a little bit more so. And if you really want to get crazy about it, you know, use the Camtasia software, or use a video editing or video recording software, and talk to yourself. I mean, document, all right, this is what I'm thinking, this is where my mind is at, this is a weekly chart, well, what does that look like to me on a daily chart? That's what it looks like. All right, well, there's a pretty good pin bar. It was on a daily chart. Maybe I bought the penetration of the break here, and I'm only targeting this level. So, you know, just starting out just to get in that habit of putting something down to tell yourself what you're going to do in advance, I think is the best place to start. Just you get in that habit of taking screenshots, writing yourself notes, and then as your skill level and as your experience level and as your confidence grows in some of these different methods, then you'll be able to see, okay, now I'm getting it dialed into what works best for me. So Cuba says, I came in late, so maybe you've addressed it, but I understand volatility is your friend when you're selling options, but now have the massive market drops affected your trades? Thanks. Yeah, you know, volatility is either going to be your best friend or your worst nightmare. I mean, and just because right now we're having a, you know, nice, healthy increase in volatility that is now coming back down, does not mean that a volatility level right now of 26 could easily find itself back up at 40 or higher in a short moment's notice. Any kind of surprise event, any kind of news event, anything that can happen. And if I'm only focusing on selling volatility, you know, it can certainly not be your friend any longer. Ultimately, if you're staying aware of your volatility, Cubist, if you're staying aware of that, but you're staying delta neutral, all right, you're keeping your T+0 line as flat as you can while your theta is staying positive, ultimately it becomes less and less about volatility and more about time decay. And that is a much more
relevant and much more powerful topic than volatility. While yes, it can certainly hurt you, if you have a relatively flat T+0 line, volatility is not going to hurt you nearly as bad as if you have a very large sloping T+0 line, which is what I ended up displaying and showing you in the recap video on the trade idea for SPY, right? I mean, that was why I closed that trade. Is we had a market that was SPT daily chart. We had a market that had basically just in a couple of short weeks dropped from here all the way down here. Trade was put on this date. It continued to drop, and as it got down here, it could have just as easily continued dropping as it did finding support and bouncing back up. So keeping that delta in check, or the T+0 line, as flat as you can will minimize the changes that volatility brings to you. And in that particular trade, that T+0 line was not flat at all. And the more we kept dropping, if we would have continued dropping, instead of taking a $60 or $70 loss, it could have easily been 3 times that. And my trade plan said I wasn't going to, and so I didn't. And that's important to recognize too. So I hope that answers the question. Forex Doug says, for butterflies, when do you decide to go for an unbalanced legs versus balanced? Again, that's going to be experience dependent, Doug. It's going to be based upon the unbalanced butterflies are going to require a little bit more margin if you're getting charged on both sides of the wings. But again, it's always going to be coming back to, I want that T+0 line as flat as I can. And if let me just bring over this right here. I'll bring over option view for just a second. If I'm going to, let's say I'm going to go into the SPY. And let's just say I want to look at some options that expire in 29 days. Well, if I want to put on, let's just say I'm going to put on an unbalanced one here, and I want to give it this kind of a profile look. I mean, that's relatively flat, right? I mean, you can see that we've got defined risk, we've got pretty flat, we've got a range in which we can stay profitable. We've got 29 days in which to be in these options where we'll have to close them before they expire. And this magenta line is going to be 1 standard deviation's worth of move over 29 days. So you'll see that there's a 68% chance that the SPY is going to get out to this outer edge boundary at some point in time in the next 29 days. There's a 2 standard deviation move that it's going to come out to here, right? Well, if instead of doing that, I say, let's go the exact same way, but let's add more time on my side. Now, I hope you can easily see, I still have defined risk, but I have a much flatter T+0 line than that one, right? I mean, that when you get out to this outer range, it begins to lose money very quickly, very rapidly with any continuation down. Versus, I've got more time on my side. Well, I can absorb and I can handle that a lot better. So this staying flat on this T+0 is really what's kind of the crux of it all and the most important thing, because that allows you to weather big market moves one way or the other while your theta is staying positive and decaying. So in terms of using a broken wing or a balanced butterfly, there's just different flavors for different traders, and you can make both of them work very successfully. For example, I could say, well, I can go like this. Let me have a very narrow window, but it's going to be balanced, and that's what it's going to let me look like. So I have just as much risk to the downside as I do the upside, but I've got a long time, 85 days till expiration, versus coming right close into expiration. I have the same kind of profile, but I've got a lot more upside risk, right? This T+0 line begins sloping off much quicker, and I've got a lot more potential profit underneath with this narrow body structure. So again, it's variations. It's what you find you like. It's what you find is consistently profitable, what fits your personality, and you learn that by just all the different styles and different time spent trading these. For me, I've always gravitated towards, the butterflies and some of the really wide out condors. That's not to say I still trade calendars once in a while. I still trade straddles. I still trade risk reversals. I mean, there are several trade variations that work very well, but you have to just kind of discover what works for your style and what you like. So which price slice do you use to look at the Greeks for a butterfly, for example? The price slice at current market or near one of the adjustment points? Okay, so I will bring over, let's look at Thinkorswim here, okay? And I will show you this right here. So let's do this. Because this platform is very, very powerful, very, very good. But again, there's these little nuances that while you're still learning it will make it much easier to understand. These price slices, I think by default, they don't even display them. So if you click that, it opens them up. If you unpadlock them, it's always going to stay at the current market price. You can add as many stinking price slices as you want, right? I mean, you can put as many as you want on there. I typically like to only keep 3, and I'll tell you why, is because I don't want too many on there. I just want to keep it as simple as I can. I keep the one on the bottom unlocked because I want to know what the current market price is. You can change that to percent move. You can change it to sigma move. You can change it to $sign. So if I know that right here, let's get rid of that. If I know that right here the SPX is at 1901, and I know that this particular trade, I have to really kind of sit up and take notice at about 1860, and I need to sit up and take notice at about 1975. Well, that's what I do as far as the price slices go on this particular trade. So this is what I'm watching, and now I can look in a quick half a second, and I can see this is where it's at. If it gets down to 1860, I'm going to be essentially at about break even on the trade. I don't have to adjust it, but I need to probably start thinking about doing something, or I can let it get all the way up to here, at which point I'll be so far away from any potential profit, I probably want to consider making an adjustment as well, just to get it a little bit closer to where the market's at. So you can put these price slices wherever you want. I typically want to have where the market's at and where I'm looking to make an adjustment, all right, where I'm wanting to do something. All right, great, thanks. Aladdin says thanks. Five says, hi Kevin, did you discuss the win-loss ratio of a trade? I kind of did, I think, in the beginning. They're all going to have variations of, win-loss percentages, and you're going to trade differently than I'm going to trade, and I'm going to trade differently than Forex Doug is going to trade, and Eladine's going to trade differently than you're going to trade. I mean, we're all going to be different traders, but if I'm finding trades that are profitable more than 50% of the time, and my win to loss reward, I don't ever lose more than I win on average, well, I have now put a positive edge in my favor, right? I mean, even if I only win 51 out of 100 trades, and every winning trade wins more than the losing trade, well, then I'm a positive trader. So that win-loss ratio, it's, for me, I like to have a higher strike rate, and I'm willing to give up some of those potential profits to achieve that, because I know that so seldom do I take a full max loss. Perfect example, all right? Oh my gosh, guys, I really need to start thinking of wrapping this up. I didn't realize it's an hour, almost hour and a half, hour, 20 minutes. Perfect example, the dynamic risk to reward. As this trade continues to develop in time, you'll see if I'm willing to, on this particular trade, if I want to make 300 and I don't want to lose any more than 300, I get down to be down about $300 in this area here. So let's just say, just for the sake of illustration, 1800. 1800, I'll be down about $300. Again, guys, you cannot make absolutes, and it gets down here, it might be 400, it might be 200, but the point here is, as time passes, see, what I want you to notice is that price down there gets less and less and less, because your T+0 line begins taking shape of the expiration graph. Now, you're never going to target what's available to you. That's why you have to have your target profits of what you want to make. And as long as I can stay within that range until I hit my target profit, I'm not gonna do anything to that trade until it either hits target profit or it gets outside of an area where I need to do something. And I know, just through my experience of trading, these variations of these styles of trades, delta neutral, theta positive strategies, that will occur 60-70% of the time when you follow your trade plan. All right, so that win-loss ratio, I did kind of talk about it a little bit in the beginning, but really it's more about finding that edge, finding your positive edge in your trade. Okay, yes. Forex Legacy says, thank you, Kevin. You are very welcome, my friend. And when are you planning your next webinar? So I'm going to try and do these once a week. Maybe, sometimes it might be twice a week, sometimes it might be every couple of weeks. But for now, I started middle of last year doing these on Mondays, and big maintenance event this weekend. Okay, so Thinkorswim's doing a big upgrade. I try and do these on Mondays, once a week, every Monday, and I think once I start getting feedback from if this time works great for everybody and Fridays work ideal, maybe I'll just keep them on that for a little while. Really, though, I'm trying to do these once a week, and I may do them more as the demand shows up, or I may do them less if, there's not that much interest. I mean, I'm really kind of just responding to whatever feedback I get from all of you guys. So I will do these absolutely as little or as much as I can. And like I said earlier, I have topics. I have almost 75 topics that I want to talk about. Just sharing with you guys things that I think are important. And some of it's going to be redundant. Some of it's going to be brand new. Some of it's going to make your head explode and your mind go, what? And some of it's going to be like, oh, geez, he's saying that again. But I think that it's important that I share with you guys what I think are going to be some of the biggest challenges. And it was by no mistake or no accident that I really wanted to spend some extra time on this first one talking about, the psychological side of it, the math side of it, talking about, let's find your edge, let's look at the probabilities, because then when you do that over and over and over again, and your data points have you trading, 2 or 3 or 400 trades in a year, if that's what you end up doing, well, you're going to absolutely find in a matter of a few years what your style is and what you like, and then you can start leaning into however that affects your life. So does that help? Yes, great. Okay. No worries. I was only asking so I can free up my calendar as much as possible. Oh, okay. You know what? I will absolutely. I will try and get one on the calendar ASAP for next week, and I'll try and gravitate them towards earlier in the week, around this time of the day. So it's 2 o'clock. Well, now it's 3:30, but 2 o'clock East Coast time is when this started. So I'm certainly not objectionable to doing them in the evening time or early in the morning. Just whatever works the best for the majority of you guys. So I will get one scheduled as soon as possible. Okay. Okay, super. So guys, that's pretty much it. I will go ahead and close it on that note. Thank you so much for taking the time out and sharing this and asking some great questions. And I'll just close on the fact of, please don't try your hardest not to let yourself get overwhelmed or intimidated. There are some new conversations and new topics and new terminology and mechanics you have to kind of get your head wrapped around, but it's going to be very fun, and I think that you guys will absolutely see the light bulb moments start going off, guys. So that's it, guys. Have a great weekend, and we will have some more coming soon. All right.